I was talking to a trader friend in Tokyo the other day, and he told me something that felt like a scene from a psychological thriller. He said the mood in the financial district is total schizophrenia. On one screen, the Nikkei is screaming past 53,000 points, and everyone is high-fiving. On the other screen, the bond market, the actual foundation of the Japanese economy, is suffering a once-in-30 years heart attack. He described watching the yield on the 30-year bond hit 3.88%, like watching a slow-motion car crash in a rearview mirror. Everyone sees the yield spiking, he told me, but nobody wants to be the first one to say the word insolvent. It's a strange, detached kind of panic. While Prime Minister Takaichi's out there winning over voters by promising to slash taxes on groceries, the big banks and insurance companies were sitting on paper losses that dwarf their actual capital. It's a vivid, almost surreal disconnect. You have the public cheering for tax breaks in a booming stock market, while behind the curtain, the losses on Japanese government bonds have ballooned to $1.9 trillion. To put that in perspective, the entire life insurance sector has a capital base of maybe $170 billion. They aren't just underwater. The ocean has swallowed them whole. It reminds me of those final quiet months at Credit Suisse or Silicon Valley Bank. Everything looks functional and stable until the exact moment the liquidity stops flowing. Right now, the Bank of Japan is effectively trapped in a room with no exits, forced to choose between saving the yen or saving the banks, all while the government pours gasoline on the fire with record-breaking spending. What's truly haunting isn't just the math, but the global stakes. Japan is the world's ultimate creditor, holding over $1 trillion of American debt. If this slow storm finally breaks, it won't just be a local crisis. It will be a global reckoning that rewrites the rules of finance overnight. The real question isn't whether the system is broken, it's how much longer they can keep the lights on before the check finally bounces. That opening text, it really does feel less like a market report and more like a thriller. We always think of Japan as, the boring, stable part of the global economy.
Exactly. Stagnant, maybe, but always reliable.
Right. But this paints a picture of a system that is basically holding a grenade with the pin already pulled.
Oh, the pin is definitely pulled. The whole era of boring Japan is over. What we're looking at is a fundamental shift, a transition from decades of quiet stagnation to a really high-stakes crisis of confidence.
And that word schizophrenia that you heard from your friend, that just nails it, doesn't it?
It does. You have the stock market, the Nikkei, partying like it's 1989.
Past 53,000.
Exactly. Meanwhile, the bond market is basically screaming fire in a crowded theater. It's a total disconnect.
Okay, so before we dive into the frankly terrifying math of that $1.9 trillion hole, I want to ground this a bit. I think it's easy to get lost in yield curves. I want to talk about what this feels like for the people who actually, build the economy. I heard a story that captures this perfectly. I heard a story about an aging craftsman in a small factory in Oda City, Tokyo, a man who had spent 40 years perfecting precision valves. He represents the industrial hard metrics that once built Japan. Recently, he watched the news about the Bank of Japan's latent losses on his lunch break, shaking his head. To him, the trillions of yen in paper debt are invisible phantoms, yet they possess the power to erase his physical reality. He feels a sense of institutional paralysis. The central bank is a captain frozen at the helm, unable to raise interest rates to kill inflation without sinking the very ship of state under a mountain of devalued bonds. I saw a comment online suggesting that while the East's rising powers act with decisive state capacity, Japan has become a museum of Western-style financialization. It makes me wonder, as a creator who tracks these shifts, how a nation that once valued the tangible output of a craftsman's hands became so deeply entangled in the fragile geometry of debt. It is a sobering reminder that when paper assets lose their grounding in physical power, the silence in the factory becomes the loudest sound of all. That image of the silence in the factory, it's just chilling. You have this guy making real tangible things.
Valves, things that work.
Yes, the stuff the world actually runs on. And then you have this fragile geometry of debt that's threatening to just wipe it all out.
Yeah.
But he mentioned institutional paralysis. I get that the Bank of Japan is stuck, but why? If inflation is a problem, you just raise interest rates. That's Econ 101. Why are they frozen?
It's a trap of their own making. Think of it like a seesaw. On one end, you have bond yields, the interest rate. On the other, you have the price of the bond itself.
And one goes up, the other goes down.
Right. They move in opposite direction.
Yeah.
For decades, the Bank of Japan kept rates at 0 to fight deflation. And to do that, they bought up, 50% of all government bonds?
Half the market.
Half the market. But now inflation is actually here. It's running hot, above 2% for years. To stop it, you have to raise rates. You have to push that side of the seesaw up.
But if they do that, the value of all those bonds they own just crashes.
It crashes. They would be destroying their own balance sheet. More than that, they'd be destroying the balance sheet of the entire country.
So it's a choice between two poisons.
Exactly. If they act to save the yen and kill inflation, they bankrupt the banks and the insurance companies holding all those old bonds. If they act to save the banks by keeping rates low, then inflation just completely destroys the currency and the public savings.
So they're frozen, paralyzed. Every exit is a disaster.
Which is why that comment you saw about Japan becoming a museum of Western-style financialization is so sharp.
It feels like they stopped caring about the factory floor and only care about keeping the bond market on life support.
That's the core of the critique. You see these other powers in the region, they're prioritizing what's called state capacity, industrial power, physical output. Japan sort of drifted into this model where paper assets and leverage seem to matter more than actually making things.
And the market can smell that witness. You mentioned the 40-year bond yield hitting 4%.
Yeah, and the 10-year yield jumping 5% in a single day. That's not just volatile.
That's a breakage.
It's catastrophic. I mean, a 5% move in a major sovereign bond market in one day, that's something you see with a cryptocurrency, not a G7 nation's bet. It's the market telling you that the put option, the belief that the central bank can always step in and fix things, is gone.
Credibility is shot.
It's shot. The market is breaking because the central bank is paralyzed.
Which, of course, brings us to the people who are actually holding the bag. It isn't just the Bank of Japan. It's regular people. I was reading another story that just drives home how dangerous this has all become for the average person. I was reading a thread about a young salaryman in Tokyo who recently discovered that his safe life insurance policy and his local bank stability are tethered to the volatile yield of the JGB. Try to imagine the quiet dread of realizing that the institutions designed to protect your future are actually the most vulnerable. This young man represents the human face of the $1.9 trillion latent loss crisis. He sees the stock market hitting record highs, yet he feels the structural fragility beneath his feet. He represents the victim of a system where debt accumulation has overshadowed real economic sovereignty. As I reflected on his situation, I felt a wave of empathy. It is easy to judge a system from the outside, but for those living within it, the cautionary tale is their retirement fund. It highlights a painful truth. A civilization cannot survive on the momentum of its past if its financial foundation has been hollowed out by the pursuit of liquidity over substance.
It's a tragedy of misplaced trust in a digital ledger that no longer reflects reality. Misplaced trust in a digital ledger. Wow, that hits hard. Okay, but let's get into the actual numbers. We threw out $1.9 trillion in latent losses. That number is so huge it feels abstract. Can you break that down? What does it mean for that salaryman's bank?
Let's try to put it in human terms. Imagine you run a life insurance company. Your capital, your savings account, let's say it's about $170 billion. Sounds like a lot of money, right?
A huge amount of money.
But you own a massive house, which is all these bonds. And because interest rates have spiked, the market value of your house just dropped by $332 billion.
So if I have 170 in the bank, but my house has lost 332 in value, I'm negative. I'm bankrupt.
You are deeply, deeply underwater. Theoretically, the entire Japanese life insurance sector is insolvent. Their liabilities to the people they're supposed to pay are now greater than the value of their assets.
And the banks are in the same situation.
A very similar boat. Maybe $240 billion in capital, sitting on about $285 billion in bond losses. They're underwater, too.
So why are the doors still open? I don't get it. Why isn't there a run on the bank right now?
It's the crucial difference between solvency and liquidity. You can be insolvent on paper, like our homeowner with the underwater mortgage.
And still live in the house.
Right. As long as you don't have to sell the house, you don't have to realize the loss, you can just pretend that bond is still worth what you paid for it.
Until you need cash.
Until you need liquidity. And that's where the repo market comes in. The repo market is basically a giant overnight pawn shop for banks. They take their government bonds there to get cash to operate.
And usually the pawn shop just says, great, here's your money.
Yes. But now the pawn shop, the market, is looking at that bond and saying, hang on, this isn't worth what you claim it is.
And that's the crunch.
That's the crunch. If the pawn shop cuts the value of your collateral or just refuses to take it, you can't get cash.
Yeah.
And that is exactly what killed Silicon Valley Bank and Credit Suisse. It wasn't just bad bets, it was that the pawn shop closed.
And if that happens in Tokyo, that salaryman's safe retirement just vanishes.
It evaporates.
That is genuinely terrifying. And into this absolute tinderbox, the politicians decide to pour gasoline. This next story, it honestly just made me angry. I saw a report about a local politician in a rural prefecture who campaigned fiercely for the suspension of the sales tax to win over his struggling constituents. On the surface, it seemed like an act of compassion. But looking deeper, it was the spark that further destabilized the national debt. This story illustrates the collective survival thesis, the idea that individual political interests must yield to the civilization's overall stability. By prioritizing short-term political gains, the government essentially traded the nation's long-term survival for a moment of popularity. I imagine the frustration of a philosopher watching this, seeing the state capacity of Japan's neighbors and wondering why his own leaders cannot act for the collective good. Reading this made me feel conflicted. While I understand the populist urge to relieve the common man's tax burden, the systemic risk it creates is a terrifying price to pay.
From a professional perspective, it's a classic example of how a lack of centralized, decisive will can lead a great civilization into a slow, polite decline. It's a harsh lesson in the necessity of sacrifice for the sake of the whole. So let me get this straight. The house is on fire, the banks are underwater, the currency is shaking, and the prime minister decides the best move is to caw. Stop collecting revenue.
It is, from a market perspective, fiscal suicide. But you have to see it from Takaichi's perspective. He needs to win an election. People are getting crushed because food prices are soaring.
So he promises to cut the tax on food. It's a populist move.
An easy win, or so he thought, but the bond market absolutely revolted.
Why? What was the immediate impact?
That tax cut creates a 5 trillion yen revenue hole. That's over $30 billion a year. Japan already has the highest debt to GDP in the developed world. So when the government basically says, we're going to voluntarily collect less money, investors here, we aren't serious about ever paying you back.
And that's what triggered the sell Japan trade we saw. It creates a doom loop, right?
A vicious, vicious cycle. The yen is weak, which is what makes imported food expensive in the first place.
Okay.
So the politicians cut the tax to help people afford the food. But that tax cut terrifies investors, so they sell the yen, crashing it even further.
Which makes the food even more expensive.
Correct.
Policy defeats itself.
Instantly.
Yeah.
You know, a 20% jump in food prices from a collapsing yen completely wipes out an 8% tax cut. It's the opposite of state capacity. Instead of making a hard choice for the collective good, they made a populist gamble, and it blew up in their face.
And I know what you, the listener, might be thinking now. Okay, this is a disaster for Japan. I feel for the salaryman. But I live in Ohio or London. Why should I care if Tokyo melts down?
You should care because your mortgage rate might depend on it. This is where we get to the global reckoning. This is the $7 trillion risk.
Okay, $7 trillion. That's not local.
Japan is the world's creditor. For 30 years, because rates at home were zero, Japanese pension funds, insurers, banks, they sent their money overseas to get a return. They own over $1 trillion of U.S. Treasury bonds alone.
$1 trillion.
They own huge amounts of European debt. For decades, they have effectively been funding the U.S. mortgage market and European governments.
So how does that blow back on me?
The key word is repatriation. It's the money coming home. Remember we said Japanese yields are now hitting 4% on the long end? Investing at home suddenly looks attractive again. Why risk currency swings in the U.S. when you can get a decent return in yen?
So they sell their U.S. bonds and bring the money back to Tokyo.
They sell. Or even worse, remember those massive losses they have? They might be forced to sell their profitable foreign assets just to cover the holes in their balance sheets at home.
Okay, so if Japan starts dumping U.S. treasuries?
The price of those treasuries crashes. And when bond prices crash, their yields spike.
Which means U.S. interest rates go up.
Exactly. Not because the Fed did anything, but because the world's biggest buyer just became a seller. Suddenly, the interest rate on a 30-year mortgage in Ohio jumps. Business loans in Berlin get more expensive. Global liquidity just dries up.
So Japan has been like this giant liquidity hose for the world, just spraying cash everywhere. And now they're threatening to turn off the tap.
Or reverse the flow. If they start sucking that liquidity out of the global system to plug the hole in their own sinking ship, it creates a credit crunch everywhere else. That's the slow storm. It's been building for decades, but when it finally breaks, it hits everyone.
It really makes you realize there's no such thing as a local crisis anymore, is there? We are all tethered to that same digital ledger.
We are. The US, the UK, Europe. They're all watching Japan so closely because Japan is just further down the same road of debt and demographics that they're all on. If the bond market can break the Bank of Japan, it can break anyone.
It just brings me back to that craftsman from the first story, the guy who spent 40 years making something real, precision valves. Tangible value. And then you look at that digital ledger, the $1.9 trillion of red ink at the banks. It feels like we've spent so long pretending that the financial economy is the real economy. But when the check finally bounces and the liquidity stops flowing, we're all going to find out a very hard truth. You cannot print your way out of a solvency crisis. You can only delay the moment the bill arrives.
And looking at those yields in Tokyo, that bill is definitely in the mail.
5. Keep your eyes on those charts.